Everywhere you look, people are asking if the stock market is overvalued and whether we're heading for a crash. But here is the thing, it's not that simple. The market might not be overvalued the way most people think. And even if it is, for long-term investors, it really doesn't matter. So in this video, we'll dig into the data and I'll share my take on whether it's time to panic or just stick with what works. First up, let's talk about the Shiller-Cape ratio. It sounds like a bit of a tongue twister, so I'll put the full name on the screen. And stick with me because it's worth understanding. At a high level, the Cape ratio shows the S&P 500's price to earnings adjusted over the last 10 years. In plain English, it's a way to see how expensive the stock market is compared to the profits companies are actually making. Think of it as a long-term valuation gauge, a tool to help put today's market prices in context. Here's an example to make it simple. Imagine a company makes £100 million in profit in a year. If the market values that company at £1 billion, the PE ratio is 10. £1 billion divided by £100 million. Easy enough. Now, the Cape ratio does the same thing, but smooths it out over 10 years to filter out the short-term noise and to show a bigger picture. So where are we today? Well, the S&P 500 is sitting at a Cape ratio of around 40. For some context, the historical average has hovered around 16 to 17. That's definitely on the high side. And historically, whenever the Cape has spiked this much, it's sometimes been followed by significant market downturns. But here's the thing. Just because history shows a trend doesn't mean it's a sure thing. Markets don't follow a script, and high valuations don't automatically mean a crash is imminent. That's why we need to look beyond just Cape and consider the bigger picture. The Cape ratio gets thrown around a lot by doomers online and in the media, often treated like the main predictor of a market crash. But it's not that simple. The reality is that markets today are nothing like markets decades ago. For example, the top companies in the S&P 500 30 years ago were mostly industrials and consumer staples. Think Exxon, GE, Coca-Cola and so on. Tech barely played a role. Fast forward to 2025 and the landscape is dominated by tech giants and innovative growth companies. So it's not really fair to compare today's valuations to those of the past, because it's a completely different market. A high PE doesn't automatically spell trouble. What really matters is whether these companies are producing real earnings and growing profits. And right now, many of them are doing exactly that. Let's look at the numbers to see what's actually happening. Over the past 3 months, a large majority of companies, around 82%, have exceeded profit expectations. For context, that's above the 5-year average of 79% and the 10-year average of 75%. Tech continues to lead the charge, with just 6 mega-cap companies driving nearly half of all earnings growth. These aren't hypothetical profits, these companies are genuinely making money. Compare that to past bubbles like the dot-com era or the post-COVID surge, when many companies had little or no earnings. Today, the market is dominated by companies consistently showing profits. So the key takeaway is that a high PE ratio alone doesn't tell us the full story. What really matters is whether these companies are generating steady, growing profits. And right now, many of them are. So while it's encouraging to see many companies are genuinely profitable, the next question is, what does that mean for your future returns? To help answer that, let's turn to some data from JP Morgan that helps put today's valuations into perspective. Here on the screen, you can see 2 charts that link today's PE ratio to the returns investors might see in the future. The one on the left shows 1-year future returns, and the one on the right shows 5-year returns. In general, the higher the current PE, the lower your expected future returns. As you can see, the 1-year chart is all over the place. Even when valuations are high, there are still years with strong returns. That's the tricky part about focusing too much on the short term. It's noisy and unpredictable. The 5-year chart, on the other hand, smooths things out. Over a longer period, valuations tend to balance, and returns generally follow suit. The main point here is that a high PE doesn't automatically signal a crash, but it does provide useful perspective. Think of it like training for a marathon. A single bad run doesn't mean you're going to fail the race. Over weeks and months of consistent training, you start to see real progress and trends. Well, the same goes for PE ratios. A short-term spike doesn't dictate long-term returns. but looking at the bigger picture gives you useful guidance. In fact, for long-term investors, especially those in broad index funds or ETFs, whether the stock market is overvalued or cheap doesn't actually change your strategy. Here is why. The magic of index investing isn't about timing the market or avoiding expensive periods. It's about staying invested consistently, diversifying across the entire market, and letting compounding work over decades. Even if the market looks expensive today, history shows us that over 10, 20, or 30 years, short-term valuation spikes matter far less than sticking to your plan. The exact price you pay now might slightly affect returns over the next few years. But in the long run, consistent investing smooths everything out. Think of it like planting a tree. You could wait for the perfect day to plant it, but the real growth comes from letting it put down roots year after year. Missing a few days or even a few months won't change the fact that it grows steadily over time. So no matter what the headlines scream, overvalued, bubble, expensive and so on, for a long-term investor, it's mostly noise. What really matters is continuing to invest regularly, keeping costs low, and not letting fear dictate your decisions. Before we dive into the next section, I'd love to hear from you. Do you think the market is genuinely overvalued right now? And are you staying invested no matter what? Or are you changing your strategy? Drop your thoughts in the comments below. I'm really curious to see what you think. Now let's talk about something that many people tend to overlook. Market concentration. The S&P 500 might include 500 companies, but most of the returns come from just a few. Right now, the top 10 stocks account for nearly 40% of the index. A level that's historically unusual. Over the past decade, you can see a clear trend. The largest companies have steadily gained more influence in the market. So why does this matter? Because when a handful of stocks dominate, the market's performance becomes heavily dependent on how those few companies do. Take the recent AI boom, for instance. A small group of mega cap tech names have soared, driving the index higher. But can they maintain this pace, or could we be building an AI bubble? Here is a simple way to think about it. Imagine putting almost half of your investment into just 10 companies. It could be exciting if they keep performing, but it also comes with a lot more risk. That's why it's a bit of a paradox. Bigger potential rewards, but bigger potential swings. But although concentration shows how dependent the market can be on a handful of companies, it's just one piece of the puzzle. At the end of the day, no chart or ratio can tell you exactly what's coming next. And the truth is, no one can predict the market with certainty. Not economists, not analysts, not even the most successful investors. That's why I stick to a simple approach. Invest in broad market index funds or ETFs, stay consistent, and keep a long-term perspective. Market concentration is just how markets evolve. The strongest companies naturally rise to the top. Like, it makes sense. The real edge comes from your mindset, embracing uncertainty, staying disciplined, and focusing on what you can actually control. For me, that means not getting caught up in whether the market is overvalued or trying to time the perfect buy. Sure, markets can drop and an AI bubble could burst. That's part of investing. Risk and reward go hand in hand. The smartest investors, however, know you can't reliably time the ups and downs. What really matters is staying the course, keeping a disciplined mindset, and concentrating on what you actually have control over. In fact, to help with this, I launched a newsletter that shares practical investing insights, focusing on psychology and behavioral investing. The goal is to help you understand why we make emotional mistakes and give you strategies to stay calm and make smarter decisions. Because the truth is, your investing behavior has a bigger impact on long-term results than the index funds or ETFs you choose. So if you want to build stronger investing discipline, sign up. I will leave the link in the description below. And in the meantime, check out this video to find out about 5 ETFs that I think are the best for long-term investing. See you there. And remember to stay hooked on investing.